What's up guys, Jake right back at it again with another investing video. In today's video, I'm going to talk about 5 stocks that are interesting buys due to all the fears surrounding the coronavirus. But before we get into the video, I'm going to tell you all why I'm wearing this shirt. So T.I. is my favorite rapper of all time. He actually got out of prison about 9 years ago. About 3 years ago, I wanted to buy a T.I. shirt and I couldn't find one other than this one. So yeah, free T.I. And with that, we'll go ahead and start talking about the first stock that I'm going to talk about today, which is going to be Exxon Mobil. Alright guys, so here we are in the Robinhood app and I have Exxon Mobil pulled up. So Exxon Mobil is a big oil and gas company, and the reason it has done so poorly lately, it's down almost 38% in these past 3 months, is because a lot of people are predicting a lesser demand for oil in the future. Because a lot of these factories in China had to be shut down for a while due to the coronavirus fears, there was less machines running, less need for gas and oil, which drove the demand for gas and oil down, and that is why oil prices have gone down as well. So the main reason Exxon Mobil is down so low is because oil prices are down so low. It's hard for Exxon Mobil to operate profitably when gas and oil prices are low. So what makes Exxon Mobil an interesting stock? Well, at its peak this past year, it was up around $80. Over the past 5 years, it's gotten up to around $90. And really since then, it has tailed off down all the way to $43. It does have a pretty attractive dividend yield at these levels. It pays out 87 cents per share per quarter. So right now the dividend is at around 7.3%, which is very high, especially for a company this size. Its PE ratio is at 14.2, which is extremely low for a company like this. And I think it might be an interesting buy because I think oil prices will rebound sooner or later. So as long as you're willing to wait out maybe some short-term losses, I think Exxon Mobil could be a very good investment in the long term. Now keep in mind that I'm talking about all these stocks today, but I have no clue if they're going to go up, down, or sideways. So as always, before purchasing any stock or making any investment, do your own research. The purpose of today's video is for me to give you investing ideas that you can further investigate on your own. I am not a certified financial advisor, so keep that in mind when you are thinking about what investments to make. So I certainly think Exxon Mobil is a very interesting stock right now. It could be headed lower, especially if fears surrounding the coronavirus get worse. But nonetheless, I think it is pretty interesting right here. So the next stock that I'm going to talk about today is Carnival Cruise Lines. So Carnival is very interesting because they are, like Exxon Mobil, have dropped off a ton in over this past year. At one point, they were up around $50, and earlier on the year, they were at around $57. Now they're only at $24 and about 50 cents. The reason it has dropped so low is because investors expect that people will take less cruises due to coronavirus concerns. Any sort of hospitality stock or like a cruise stock or an airline company, they tend to take a hit whenever there is a epidemic such as the coronavirus, because generally it's thought that people will try to avoid different public transportation and any sort of way that they could come in contact to other people who may have the coronavirus. So Carnival Cruise Lines is down very far. Because it's dropped so low, this has pushed its dividend yield up to 7.4%. And yes, this was the company that I was talking about in my intro. Its PE ratio is down to 6.3, which is incredibly low. To put that into perspective, the Standard & Poor's 500 PE ratio is at around 20 right now. So it's kind of insane to see Carnival Cruise Lines trading this low. What do I think will happen with Carnival Cruise Lines? It is very hard to tell, but I think over the long term, I think they'll do okay as long as they can survive maybe the next few months of a lesser demand for their cruises. I think as long as they can remain profitable, and they have been pretty profitable, then I think they will be successful in the future. I think they could be a good long-term investment. Over the short term, though, I mean, this 3-month chart looks pretty ugly. They could continue to go down. Something interesting is they did jump up 10.5% today, and they're up almost 2% after hours. So they did recover some of the losses, but they're still down 24% on the week. The U.S. government actually released a statement the other day advising people not to take cruises as it would put them at a greater risk to catch the coronavirus. So keep that in consideration when you are considering potentially buying Carnival Cruise Lines. So the next stock that I want to talk about today is another stock in the energy sector. It is Energy Transfer. And this company specializes in pipelines and different ways of transporting oil and natural gas. They have dropped pretty considerably over the past 3 months. They're down 34%, down 37.8% in the past month, which is insane, down 34.4% this past week. These kind of drops are insane. You don't see them very often. But the reason I am kind of interested in Energy Transfer is, one, I own a share of it, and two, it pays a 31 cent dividend every quarter. So its dividend yield right now is 12, which is incredibly high. If they could sustain this dividend, then this obviously would be an awesome investment. But the way it's priced right now is, I think a lot of people don't expect them to be able to sustain this dividend. So I would personally go out and do some more research, see if Energy Transfer will be able to sustain its dividend, dig into its financial history, take a look at its cash flow. One thing I like to do for dividend stocks is I look at how much money they earn per quarter, and then I look at the dividend and kind of see what the difference is. So here it kind of shows that Energy Transfer usually earns around somewhere between 30 and 40 cents per quarter. So this dividend payment is a bit unsafe, I would say. Obviously, if they are paying out more per quarter than they're actually earning, then there's a problem. So Energy Transfer definitely is one of those riskier dividend stocks, but I don't know. It may end up being a potentially good buy. So we'll have to see. So the next stock I'm going to talk about today is American Airlines. American Airlines is a airline company, as you might have guessed. So airlines tend to do poorly whenever there is a epidemic because people try to stay away from public transportation, try to stay away from places where they could catch the coronavirus. Not to mention they probably will also travel less, try to stay home more. So a airline like American Airlines is likely to do poorly when there is any sort of epidemic. So American Airlines is very interesting right now because it actually has a PE ratio of 4, even lower than Carnival Cruise Lines. Its dividend yield is at 2.5% right now. I think there's a good chance that they may have to cut their dividend. Something else that I haven't mentioned but is a very real possibility is stocks like American Airlines and Carnival Cruise Lines. If this coronavirus is an issue for long enough, they might be operating at a loss so long that they could end up going bankrupt. Now, do I think this will happen? Probably not, but you have to be aware of this possibility if you are considering investing in a company like American Airlines or Carnival Cruise Lines. So where do I think American Airlines is headed? Well, personally, I kind of think that it might not be a bad long-term buy right here. I really don't think that the government would let major airlines fail. If you kind of think about it, air travel is not a necessity, but it's pretty important. And I think if something was to go terribly wrong, I think the government might bail out a company like American Airlines. I know that is getting way, way ahead of things. There's no reason to believe that they will go bankrupt or anything like that, but it is something to have in the back of your mind just in case. So the last company that I want to talk about today is actually a very defensive play. So all the stocks I've talked about so far today, I would consider more offensive or very aggressive plays to make right now. They're all stocks that have been beaten down lately, and I think they might offer a good value right now, but there's also a very good chance that they could drop even further and you could lose money. American Water, I would consider to be a much safer stock. So American Water, this past week, it's up 3.5%. This past month, it's up 2.2%. Or the past 3 months, it's up 12.3%. Past year, it's up 34%. And the past 5 years, it's up 163%. So whenever there is a lot of risk surrounding the economy, where there's something like the coronavirus going around where people are fearful, utility stocks tend to do pretty well. They tend to be safe havens. American Water, it does have a PE ratio of 41, but I think the main reason behind that is because it's just considered to be so safe. They'll probably meet their goals for growth over the next few years pretty easily. And then they also pay this 1.4% dividend, which they will likely slightly increase over the next few years. So the reason I wanted to talk about this stock today is, like I said, just to give you all a more safer stock, a stock that is not likely to see these huge 30-40% drops, followed by like a 10% gain if we're talking about Energy Transfer. So I wanted to show you all this stock, and with that, I think I'm going to wrap up today's video. Thank you all for watching. Please let me know what you think of these stocks in the comments below. Please hit that like button if you've enjoyed today's video, and subscribe to the channel so you all can watch my future videos. With that, JGraph out.